Hey everybody, welcome to Mortgage Today for Tuesday, September 26, 2023, and oh, what a day it was. MBS were down 5 basis points on the open. Yields on Treasuries and European government debt dropped after hitting decade lows. The Bloomberg Dollar Index was little changed following the strongest close since December. Oil retreated as the impact of the rising dollar sapped demand. The threat of tight monetary policy is undoing some of the market's biggest gains this year in high-flying tech stocks. These growth companies are prized for their long-term prospects, but hold less appeal when future profits get discounted by higher rates. The FHFA Home Price Index came in today. It came in up 0.8 month over month on a 0.4 estimate. That means it's up 4.6% year over year. Central and mountain regions rose the most. Consumer confidence came in at 103 versus a 105.5 forecast. It was 108.7 previously. Case Shiller Home Price Index came in up 0.1% year over year versus a negative 0.3 forecast. It is now down 1.2% previously. The index has now recouped all of the losses experienced between June of 2022 and January of 2023. New home sales fell 8.7% year over year to a seasonally adjusted annual rate of 739,000. This was up from 5.8% on a year over year basis. The inventory of homes for sale ticked up to 436,000, which is a 7.8 month supply. Given the shortage of existing homes for sale, activity in the housing market will need to be driven by new home sales. Investors are awaiting a fresh round of PCE data due out Friday as they weigh in on the potential of another rate hike before year end. The Fed also adjusted its forecast for rate cuts next year at the last meeting, signaling that rates will likely remain higher for longer as the economy continues to show resilience and inflation remains elevated. Threat of another government shutdown also looms as negotiations carry on and parties remain divided with the October 1st deadline. Bonds improved in the overnight session, reversed course the moment that the U.S. bond market hit the 820 open. The selling wasn't intense, but it was consistent from that point on. 10-year ultimates set new long-term highs just over 4.56%, and MBS lost an eighth to a quarter. The most interesting market mover of the day was the complete absence of compelling market movers. This fits the repricing narrative discussed in the morning. The silver lining is that the day-over-day losses are far smaller than those seen yesterday, but it's too soon to conclude the bonds are setting in for next week's big ticket data. MBS closed down 20 basis points on the 6.0 coupon at 98.75. So 98.75 is putting us up here in the top end of this very wide range bordered by the 25-day moving average as the ceiling. And the floor is all the way down at 98.804. So we sure hope we won't test that. We also got news that the Chinese developer Evergrande is calling off talks with creditors and appears to be headed towards bankruptcy. This is one of the largest home builders and construction companies in the world, and a lot of people are calling it China's Lehman moment that might push it into a great financial crisis over there. In terms of financial crisis at home, credit card losses are rising at the fastest pace since the great financial crisis of '08. Goldman Sachs predicts that credit card losses will continue to climb through the end of 2024 and early 2025. But what is unusual with this is that losses are accelerating outside of an economic downturn. That's bad.